Hi, thanks for joining us for Financial Symmetry's October 2023 market update video. I'm Grace Cavantes, and as usual, I have Mike Eklund with me, and we're going to be going over some highlights in the markets right now, as well as long-term patterns that we've seen over time. So with that, I'd like to share with you that none of this is intended to be investment advice. It's for informational purposes only. So please keep that in mind. All right, Mike, want to get us started?
Yeah, thanks, Grace, and thanks everyone for listening again this quarter. I think this is year 2 or 3 we're involved in this update, so thank you for those who've been following through or listening to us in the past. So this is kind of what's happened over the last 1, 5, and 10 years. So a couple things to note. First of all, we call it kind of our intermediate term. I would say short term is less than a year, long term is more than 10 years. We really, at Financial Symmetry, don't focus on the short term. That's why we're purposely only showing the last 1, 5, and 10 years what has occurred in the markets. So the summary is that over the last year, the global stock markets have done very well. Returns from anywhere from about 11% to 24%, depending on US versus international stocks, with bonds up between 0 to 3%. So over the last year, it's been a strong year. Now, many might not think that because on a quarter-to-quarter basis, there are good and bad quarters. But if you look at on an annual basis, it's been a very strong last 12 months. So with that, I'll pass it off to Grace to talk a little bit about those last 12 months.
Yes, if you have watched the news or read any media anywhere, you've probably seen a lot of negative headlines over the past 12 months. Things like high inflation or Silicon Valley banks collapse, or the continued war in Ukraine, or the multiple debt ceiling discussions. And a lot of those have made a lot of investors feel a little nervous. Now, this chart shows us that there are always going to be negative headlines. However, we can see over time that the market continues its upward trajectory. So this reminds us that the day-to-day news headlines are not what we should be making investment decisions based on. We need to keep a much longer-term focus when it comes to investing.
Now, that's a great point, Grace. And to the next slide, one of the key questions we keep getting these days is with interest rates much higher, should we change our strategy? Should we invest less in stocks and more in bonds? Because yields are much higher for the first time in 15 years for a lot of folks. And so this chart on this page kind of shows you the starting yield on the left here for a 10-year treasury, and then compares that to how on average the stock market has done over the next 1, 5, 10, and 20 years. And kind of one of the key takeaways I take away is there's really not much correlation between the starting yield and how the future stock market returns have been. I mean, the reality is even with a low starting yield or a high starting yield, we've seen very strong stock market returns. And this is because what's called the equity risk premium. You get paid more typically over time for owning stocks or businesses than bonds. And so our summary takeaway from this slide is it's not a time to change your bond allocation or your investment strategy. But for investors today, they are going to benefit from those higher yields in terms of higher returns, which is great news.
This next slide, it shows us some of the risk of holding one or too few or a handful of very similar companies in your investment portfolio, or only holding those. So the Magnificent Seven is what this slide is about, and that refers to the following companies: Apple, Microsoft, Alphabet, Amazon, NVIDIA, Tesla, and Meta. So those are some companies we're hearing a lot about now. They're very large, and they are a really big portion of the S&P 500. This slide shows us that 2023, that bottom half, this year they have been over 2/3 of the return of the S&P 500. However, we have to keep in mind that last year, they accounted for a large portion of the negative returns of the S&P 500. So just holding those means you're taking on a lot of risk. So we want to remind you that when you're investing, it's important to be well diversified so that you're not holding a few companies that are going to have a huge swing upward or a huge swing downward in any given year. We need to remain well diversified, holding many companies from all over the world that are all different types of companies and big and small. That helps to eliminate a lot of this company risk that you would have if you just hold the Magnificent Seven.
No, that's a great point, Grace. And we have heard questions from folks saying, well, why don't I just own these companies because they're going to dominate the global markets over the next 10, 20 years. So why even own, like you said, these other companies in the US as well as international stocks when all we really need to own are those 7 stocks you referenced. Well, a good reminder is, looking back to history, and this is in the US market only, is once these companies become one of the top 10 companies, as you see by the slide here, that on their way up to becoming one of the biggest companies, they typically outperform the market. They do very well. And we've seen that from those seven: Microsoft and Apple and Alphabet, Meta, for example, have done very well. But what the slide shows us is once those companies become, one of the top 10, their future returns are typically lower than the market. So over the next 5 and 10 years, they typically trail the market by over about 1 to 1.7% per year less annually. So why is that? Well, first of all, think about some of the names that were once, kind of the top companies that were going nowhere. Companies like GE, Exxon, IBM, AT&T. If you ask someone 20, 30, 40 years ago, there was no one would have an idea that those companies would not be the largest companies today. But since then, their results have been significantly underperformed the market. And that's why it's important, like you said, to stay diversified, because capital, the reason why this occurs is because of capitalism. And the old saying is, your profit is my opportunity. And so there will be, in the next 10 years, there's going to be, 10 new companies or 8 to 10 new companies that will be on this list that, looking back, we would have said we should have known these were the next big companies. But at the time, our focus was on that magnificent 7. So once again, to Grace's point, it's important to stay diversified because history shows us the top companies today are unlikely to be the top companies in 10 or 20 years from now.
Moving on from stocks, we want to talk a little bit about bonds, which there's been a lot of buzz about, particularly because it's been challenging being a bond investor over the past couple of years. But don't give up on your bonds just yet. We can see from the chart on the left that we just had one of the biggest bond drawdowns in history. But then on the chart on the right, it shows us the returns that we've seen after the 2 worst periods of bond returns in history, which were pretty good. So what we've seen is after poor bond returns, we see good bond returns. So that's something to keep in mind.
Yes, now's not the time to give up on your bonds because obviously today, with, like you mentioned, historically much better returns, and also you get a much higher yield today than we've had in the past. The next one is a topic we haven't talked much about, but I thought it would be important to bring to our listeners' attention, is that every year a firm called Morningstar looks at the performance of the investments, the mutual funds or ETFs, and compares that to the actual investors in that mutual fund or ETF and how they performed. So many think that, well, obviously they're got to be the same, right? Because investors, they're smart, they time when to get in and out of the fund. But the reality is they're not. Things don't work out that way. And so the results from the most recent report show that the typical investor in a mutual fund or an ETF trailed the actual investment by about 1.7% per year over the last 10 years. And so they've been doing this report for about 10 years now, and every year it's somewhere between 1.5 to 1.7% is the gap where the investor trails the investments. And so it's another reason why I always tell folks, I think investor behavior is the number one driver to investment success. Because most people get too excited about an investment when it's doing well, and then get too scared when it's doing poorly. A good example of this is over the last few years, there's a fund company called ARK Investments, ARK ETFs, which primarily invests in technology companies, that their funds have done relatively well, but the investors in the fund have done very poorly because they tend to purchase the fund after it's done really well, and then they sell it after it's done bad. And that's exactly opposite of how you want to invest. And so this slide just provides some data and backup to kind of what we discuss with clients and prospects all the time, is that a lot of folks don't do a great job on their own because they tend to chase winners and sell losers, which is not the best approach long term.
Next, we're going to look again at Vanguard's 10-year market outlook, because it continues to be very similar to Financial Symmetry's outlook, which is that the highest expected returns over the next 10 years should be coming from international companies or small companies or value companies. We've seen this from other research firms as well, but Vanguard is just a really well-known and well-trusted company, so we like using theirs. Alternatively, the lowest expected returns over the next 10 years are from U.S., particularly growth stocks, cash, and then U.S. Treasury inflation protected securities. So that's something to keep in mind going forward.
No, that's great information, Grace. And it's a good reminder from the previous slide is that typical investors would chase what's done well. And so they'd want to buy more of the growth stocks, which is that magnificent 7, or the tech stocks, and want to sell the ones that have done poorly, like international or small companies. And that's exactly what you want to do for long-term success. Exactly opposite you want to do. And then finally, we've shown, if you've been watching this webinar in the past, we've had this slide in every time. I like to call it our vitamin C. You need your vitamin C, as well as this is the 3-step investment process that Financial Symmetry implements with all our clients. Obviously, we start with developing your investment plan, making sure you have enough in bonds or cash to support spending over the next 5 to 7 years. And then you want to own stocks for long-term growth. We believe in implementing that plan through low-cost mutual funds and ETFs tilted towards higher expected returns. As Grace had mentioned, those tend to be international, small, and value stocks. And then finally, we'll be monitoring the plan. And that's what's called opportunistic rebalancing. When the market goes down, we want to buy. And when it's too well, we want to sell. And then we want to continue to evaluate your investment plan for changes as you get closer to retirement. Maybe the kids are going to college. Maybe you're changing careers. And those are good times to evaluate whether or not your investment plan needs to be adjusted.
And thank you to our viewers for joining us today. If you have any questions for us, feel free to reach out. You can go to our website. There's a Talk to an Advisor form you can fill out if you're interested in talking to a Financial Symmetry advisor. And also next is our contact information. So you can reach out to Mike or me with any feedback, questions, or thoughts. We'd love to hear them. And thanks again for joining us.
Thanks for joining us. See you next quarter.